Hello and welcome to Tech This Week. It's raining funding for tech startups as we witness a lot of funding announcements this week. This day started with ride-hailing major Ola grabbing $500 million from Temasek and Warburg. Yesterday, social commerce platform DealShare secured $144 million, which is about 1,076 crore rupees in a Series D round of funding led by Tiger Global. The round was co-led by returning investors from Westbridge Capital, Alpha Wave Incubation, and Z3 Partners. It also saw participation from partners of DST Global, Matrix Partners, and Altiria Capital. The Jaipur-based company's valuation has now reached $455 million. In today's episode, we'll be joined by Mr. Medda, co-founder and chief business officer of DealShare, to discuss the deal in detail. But first, let's take a look at the top headlines from this week. American investment firm Tiger Global has also led an investment round of $100 million in used cars platform Spinney for its Series D round. The fresh round has come after a small gap of 3 months for the Gurgaon-based company, which scooped up $65 million in its Series C round in April 2021. Other investors who participated in the round include Avenir Growth and General Catalyst, which invested $17 million and $10 million respectively. Next up, Temasek and an affiliate of Warburg Pincus are investing $500 million in Indian ride-hailing giant Ola. Ola's co-founder and chief executive officer Bhavish Agarwal is also participating in the new investment. This is the first time SoftBank-backed Ola has raised money since its Series J financing round, which was 2 years ago. In a statement released today, the company said that the investment comes ahead of its IPO. Ola's EV business, Ola Electric, is also in the market to raise money. And in a tweet earlier this week, Agarwal had said that the company will soon start the production of its e-scooters. While Ola plans for its IPO, Zomato's initial public offering has turned out to be a major winning bet for several private equity investors and early backers of the online food delivery company. Zomato's 9,375 crore rupees IPO will hit the market on July 14th. And this would be the second biggest IPO since SBI Cards and Payment Services, which was a 10,341 crore rupees issue in March 2020. Earlier this week, Zomato's early investor InfoEdge modified its exit game plan. The company said that it will sell only 375 crore, which amounts to $50 million worth of stake in Gurgaon-based Zomato's IPO. Previously, it had approved an offer for sale of equity shares worth up to 750 crore, amounting to $100 million. Zomato's top executive announced its IPO during a virtual press conference where they mentioned the launch of its grocery section on its app, which is expected to go live soon. And Akshant Goyal, chief financial officer of Zomato, also confirmed that the company has invested $100 million in Grofers. This week, TechCircle exclusively reported that health tech unicorn FarmEasy has closed its Series F funding round at $500 million. The round values FarmEasy parent API Holdings at $4 billion. 7 private institutional investors, which are Think Investments, TPG Growth, Temasek, V Capital, Process Ventures, Oreos Venture Partners, and Kotak Private Equity Fund, participated in the round. The round also includes Thyrocare promoter A. Velumanis, imminent investment of about rupees 1,500 crores, which is approximately $200 million in API Holdings for a 5% stake. The round is a combination of primary and secondary transactions. Separately, Tiger Global Management has joined the FarmEasy cap table as part of its previous Series E round, which was closed in April, which was led by Process Ventures and TPG Growth. FarmEasy recently announced the acquisition of a majority stake in Thyrocare Technologies for $613 million. As part of the transaction, FarmEasy will acquire 66.1% stake in Thyrocare at a price of rupees 1,300 per share and will make an open offer to buy an additional 26% stake as per regulatory norms. Moving on, Jaipur-based DealShare has raised $144 million in a new financing round as it looks to expand its presence in the South Asian markets and eye opportunities in international markets. The round, dubbed as Series D, was led by Tiger Global and valued the startup at $455 million post-money, up from the pre-money valuation of $50 million in Series C. To discuss the deal in detail, we are now joined by Saurajendu Medda, co-founder and chief business officer of DealShare. So, Medda, first of all, thank you for taking the time out and joining us today.
No, it is our pleasure as well.
And And congratulations on the big funding round, $144 million, huge funding.
Thanks for that.
So we'll start with how exactly are you people planning to, deploy the funds?
Three big areas where we will invest into. One is, like we have already said, that current footprint of 40 cities, we want to take it to 100 cities and towns by the end of this year. So there is a lot of warehouse and logistics infrastructure that needs to be created for managing that complexity of operations. And the better infrastructure that you build there leads us to also reduce our operational expenses on the operations front, on the fulfillment front. So that is one big area where we'll invest our funds into. The second big area is really on the technology. So if you look at our demand generation model, most of the demand is coming through the social modes, and that is where you have artificial intelligence and machine learning coming into play. We already have taken good talent from the country onto this space. We have a very senior AI person from Flipkart who is now leading the agenda on the demand generation through AI-driven tools, AI and machine learning tools. And we will continue to fortify that team on the demand generation side, and that is where we'll invest a lot. And on top of, and that is where we'll also attract both indigenous talent as well as some international talent, because a lot of AI work is done outside the country as well. And on top of that, we would also want to invest into technology on the operation side, on basically the warehousing and logistics side, because fortification of that front through technology is very important. So that's second big area. And third big area is, like you know, that we are the only ones and the pioneers who are basically aggregating small manufacturers on the grocery and essential space. So this network is not available in the country. They are spread across the length and breadth of the country, but not organized well. Now, our endeavor for the last 2.5 years is to basically bring these manufacturers closer to the consumer's mouth by disintermediating the entire chain of sales and marketing channels that lie there. So we'll continue to invest a lot on that front, so that finally the whole mission of the organization is to bring high quality merchandise at low prices to mass India. So that is what that needs a lot of investment on the supply side as well to onboard these consumers. So these are the three assets that we'll keep on building.
All right. And also, will you be able to elaborate a bit on the technology side, because you mentioned that you have hired an AI person. So how exactly that functions?
So if you look at the whole gamut of social commerce, now if you look at the world models which have done well. So on one side, there is Pinelabs of China, which basically have exemplified what gamification and group buying kind of tools can do to social commerce, because that brings a lot of consumers together and hence create demand. And on the other side, you have models like Shinshu Nishwan, etc., which are doing very well on the community leader model. Now, we have taken inspiration from both of those and Indianized the model completely to create the full stack of social commerce, where things like group buying or gamification or community leader model of demand generation, all of that come together. See, at the end of the day, the reason why one of these models cannot be exactly copied into India is because the propensity to spend per capita in the country is less, and the gross margins on the essential space are very less. Hence, you need an aggregation of all these tools to create huge amount of demand, where low AOVs can be basically aggregated together and still unit economics can be made. So this needs a lot of understanding of consumers, consumption behavior, their social behavior, how they basically are interacting with each other, and what are they influencing in terms of changing behaviors for their peers and their family members. So that is where a lot of machine learning would get into, and also understanding consumer psyches, consumer behavior is where we'll use a lot of machine learning and AI tools to access demand from this market.
All right. And also, if I were to ask, what gives DealShare an edge over the companies which are already operating in this space, say like Meesho?
So I think very different spaces altogether. So starting from the choice of category itself. Now, Meesho has been primarily operating in the fashion space, which is like 10% of India's retail, whereas we chose the largest use case in terms of grocery and essential, which is around 70% of India's consumption. Now, the reason we chose that is basically we strongly believed that for any e-commerce model to become profitable, and that is our first endeavor, because we believe that for 10 years there have been billions of dollars that have got into e-commerce, but not one single profitable model is there. And our first thesis, even before we started, is that to make the model profitable, it has to be highly relevant for the mass population. Otherwise, demand aggregation and densification will not reach a stage where the model can essentially become profitable. So that's the first big difference, and hence the use case and basically the applicability becomes very high. So that is first. Second, I think the choice of sourcing. We patronize the small and medium manufacturers and the local brands over top brands and all of that, especially in this grocery and essential space where nobody else does that. Now, these manufacturers are heavily dependent on either doing contract manufacturing for top brands or dumping their good quality manufactured products at some local wholesale. Now, we are for the first time giving them an opportunity to organize in the manner that they understand well. So the technology is also understood. It is made so simple that they understand how to onboard themselves, or in fact, we do a lot of handholding and we keep the focus very sharp. So that's very different from what Meesho is doing. Third, I think it is a very sharp retail model, sharp yet scalable. So for each location, we give only 2,000 odd SKUs, 1,500 to 2,000 SKUs, which comprise of 90% of consumption basket of these families. Rather than saying that I give you a hell lot of choices, we know exactly what is fast moving and what is highly relevant. And that is where we spend a lot of time understanding the consumer behavior. And that sharpness allows us to keep a very frugal and efficient operations model. And that is why the unit economics actually stack up well for us. We are already very close to breaking even.
You could give us some numbers. What's the traction on the platform, like customer acquisition or profit, revenue, ARR?
Yeah. So we are just a 2.5 years old company, very young, by the way. And by now we have already onboarded more than 3 million consumers on our app. And we have hit a GMV run rate of $200 million ARR already, and growing very fast. So growing around 30-40% month on month. And we are also increasing our footprint very fast. So like I said, we are at around 40 cities and towns now in 5 states. And we are basically planning to increase our footprint to 100 cities and towns in 10 states by the end of this financial year. So that's our goal. Today we service 1 lakh orders, 100,000 orders per day. And this space is also increasing at the same rate, like a 30-40% month on month. So, and we see this traction going on. By the end of this year, we are very confident of hitting a $1 billion GMV run rate.
Moving on, Pinelabs has closed a $600 million financing round as the company sets the goal to explore the public markets by next year. The round was led by Fidelity Management and Research Company and the new investor BlackRock. Other participants in the round included Ishana, Treeline, and others. Pinelabs is now valued at $3 billion, and through changes in its business model over the years and strategic acquisitions, it is now eyeing a larger piece of the fintech pie in the Southeast Asian market. Next up, e-commerce focused logistics tech startup ShipRocket has raised $41.3 million, which is 305 crore rupees as part of its Series D1 funding round. The funding round was co-led by PayPal Ventures, InfoEdge Ventures, along with existing investor Bertelsmann India. Existing investors, March Capital and Tribe Capital also participated in the funding round. Besides strategic partners such as Razer Pay and Innovent Capital, the prominent entrepreneurs, including Cred founder Kunal Shah and Zomato founder Dipinder Goyal, also contributed to the funding. The fresh capital will be used for global expansion, starting with the Middle East, co-product upgrade, research and development, and hiring. Part of the funds will also be deployed for the adjacent product development and enable retailers to improve the post-order consumer experience. Next up, payment solution provider Razer Pay partnered with Mastercard to launch Mandate HQ, a payment interface that will help card issuing banks to enable recurring payments for its customers. Razer Pay aims to integrate Mandate HQ with more than 50 banks in next 12 months. Earlier this year, RBI had issued a framework for processing e-mandates on recurring online transactions. It has made AFA, which is additional factor of authentication, mandatory for all recurring transactions below 5,000 rupees on debit cards, credit cards, UPI, and other prepaid payment instruments. And all stakeholders are required to ensure full compliance with the framework by September 30th, 2021. Razer Pay had said that Mandate HQ is an API-based plug-and-play solution that reduces the go-live time for any card-issuing bank that wishes to enable recurring payments for its customers. It is a solution that can be fully integrated with any bank within 7 days as opposed to other solutions which normally take a few weeks. This is what Razer Pay said. As big tech companies such as Amazon, Google, Apple, Facebook, and Microsoft look to enter the digital financial services and payments gateway sector, the RBI has raised concerns regarding their functioning and operations in these sectors. RBI has said that big tech companies are likely to become dominant players in the financial service sector in the country and are also likely to pose a threat to existing banks, payments companies, and NBFCs. It also stated that these companies would bring their own set of challenges to regulators in advanced and emerging markets. Big tech is usually the term used to refer to the companies with a market valuation between $1 to $2 trillion. With their monopolistic position in various markets, RBI pointed out that big tech doesn't have any transparent governance structures due to it. They can bypass regulatory limits and scale in financial services by leveraging its networks. Additionally, the regulator also stated that while these companies can make the financial system more efficient and provide people enhanced access to financial services, they also bring in possibility of risks related to data privacy, antitrust monopolistic competition, domination practices, and cybersecurity risks. Well, with that, it's a wrap on this episode of Tech This Week. Do stay tuned in and log on to TechCircle.in for many more interesting news and updates. Thank you very much for watching.